Hello, and welcome to another edition of Real Estate Edge. Economic and housing market indicators suggest the economy is gaining positive momentum, which is benefiting the multifamily market. To address these and other multifamily issues is our guest, Laura Smith, Managing Director of Berkadia. Laura, thank you for being with us.
Thank you for having me, Gary. I really appreciate it.
Give us just a brief overview of Berkadia, would you please?
Sure. Berkadia was formed as a joint venture in 2009 between Berkshire Hathaway and Leucadia, now Jefferies Financial.
Oh, Warren Buffett's
Warren Buffett's
company.
shop. I'm very, very humbled and honored to work for him.
Indeed. Laura, there seems to be a continuing strong demand for new multi-family facilities throughout the country. Is that a good observation?
Absolutely. Multifamily has always been the darling of investors, and
At least for the time being, huh?
Well, no, I think it's been consistent year after year.
Really?
That's been the asset class that just keeps on giving. Everybody needs housing, of course.
Of course.
But as of last year, there were 2,140 lenders that made loans totaling over $360 billion. So I think that even during COVID, multifamily's consistently strong.
That's a lot of zeros. Well, given this pent-up demand, this continuing push, what's behind this continuing demand? What's driving it?
From the multifamily sector, there's a number of issues that are driving demand. First and foremost, there's a 24% increase in home prices this past year alone. Mm-hmm. Average home prices is increased to $307,000.
Nationally.
Yes. Mm-hmm. And net absorption for multifamily has outpaced deliveries by 37%. And the national vacancy is now 4.7%, which is more than a point and a half lower than during COVID.
Yes.
So,
do you think that the market in the future, near future, is close to creating an oversupply of a market?
No, I don't think so. In addition, you've got the age group 18 to 35. In the next 5 years, they're projected to add about 22 million more in population. Mm-hmm. So there's plenty of demand
we all have
out
to have
there.
A place to live.
Everybody has to have a place to live.
Can you give us an idea approximately how big is the market, multifamily market, in terms of number of projects throughout the country, just approximately?
Well, the population of the U.S. is 333 million. Mm-hmm. About 140 million of that is housing units, and 65%, typically 65% is single-family home ownership, and there's 35% that's dedicated to renters and apartments.
And is that 35% pretty consistent a year in and year out?
It's actually increasing. In some markets, it's much higher than 35% because you've got empty nesters moving out of their homes, selling. You've got more single-family coming online in that age group that I just mentioned. So you've got real strong demand.
So in the foreseeable future, you don't see that demand hitting any level of equilibrium where we have overbuilt?
No. If you look at Chicago as an example, about 50 million rental apartments.
So approximately 50 million rental apartments that are online or currently available?
They are currently available.
Currently available. Is there any particular part of the country that is experiencing excessive growth that kind of stands out in your mind?
I think Phoenix is a kind of an unsung hero, and Tucson rents in Phoenix, and I just checked that yesterday, have trended up year over year by 27%, which is extraordinary. You've got the normal New York. You've got Nashville at 17.5% increase. Dallas-Fort Worth is always in the top. There's always building going on there. Miami, in the metro level area, top markets for absorption this past year, Miami absorbed 8,500 units. Charlotte, 4,500 units. Orlando, 4,900 units. And surprisingly, Chicago tops the list with almost 7,800 units.
Given this level of activity and the increase in rents, will there be a point at which the market just cannot afford to adjust to this continuing increase in cost?
That's a great question. And, there are 46 million people today that cannot afford housing because of the housing prices. And rents can continue to escalate in markets, which is great for developers. But on the single, on the looking at it from a more altruistic perspective, and the mission that I have to provide affordable housing in partnership with HUD, we're really trying to bridge that gap and provide more low-income housing tax credit financing and allow for people to live more comfortably and not spend over 30% of their paychecks on housing.
I understand some states have either passed legislation or are considering legislation that will require new projects to offer a certain percent of the units at a certain economic level that low to medium income families can afford. Do you see that spreading throughout the country?
Yes and no. It depends on the market and the area. I'm working on a project in Silver Spring, Maryland, and they have an affordability requirement. I think it's a natural and very positive outcome that I wish more municipalities would adopt, because right now there's not a single county in the United States, and there are a lot of counties in the United States that has sufficient housing to support the
to accommodate the demand.
Yeah.
Kind of switching gears a little bit, is it difficult to find adequate financing for all of these projects that are coming out of the ground?
During COVID, yes and no. It depends on the project that you're trying to build. If you have a stabilized project that's been performing and has decent set of operations and statements, we can easily refinance that asset. If you're looking to do a new construction project, we need a market study. We need to show that there's demand. If it's affordable, the demand is going to be there. That's a kind of a foregone conclusion. So we do a lot of affordable housing, but we also do luxury market rate housing on golf courses. So
Can you kind of summarize the different financing options? Give us some different ideas that.
Sure. My area of expertise is with HUD, all things HUD, and basically we provide long-term non-recourse financing, 35 and 40-year loan amortizations, fully amortizing loans, up to 85% of appraised value.
Are there minimum or maximum dollar amounts on those programs?
No, there are no maximums. However, you get above, for HUD, and this is for HUD, if you get above 75 million, we're going to look at the asset a lot more closely. We're going to underwrite more conservatively with different debt service and value constraints.
Sure. Are there different financing programs or options for existing facilities versus new facilities that are just coming online? So the programs are different. Are they? How do they vary? What are some of the basic differences?
There are a lot of different programs. For construction, typically borrowers will either opt to go with HUD 221D4 financing. That's the 40-year non-recourse construction that it flows right into a permanent loan up to 85% of costs. It's very popular. They'll also go to their local banks and get a conventional loan and then come back to us for an agency takeout, either Fannie Mae, Freddie Mac, or HUD for long-term financing. Or we can, typically it's either HUD, which I know has the best loan terms available in the marketplace. If you have the time to go through the process, right now because of the backlog, primarily caused during the pandemic. Construction loans are taking close to 18 months to get finished, from start to finish to close.
How long does it take to get approval?
It takes about 16 months, and then you add 2 months for closing, going through the HUD process.
That's just
So
to start the building process. We're talking about 16, 18 months for approval.
right. So you want to get me involved, or our team involved as soon as possible.
I can see
As
that.
soon as you purchase a site, give me a call, and we'll walk through the steps required to get
Now,
the financing
why is it
in
taking
place.
so long? Is there just that much demand for HUD-related financing?
HUD's volume has roughly tripled over the last three years. When the pandemic shut down the markets, a lot of lenders jumped out of the pool and decided to sit on the sidelines, and opted to wait and see what happened. And so HUD, in times of economic downturns, they people rely on HUD to keep liquidity
Of course.
rolling through the U.S. economy.
Is it safe to say that the larger the project, the longer it takes for approval?
No, not necessarily.
No?
Not necessarily. It takes me the same amount of time to do a $10 million project as it does to do a $100 million project. The steps are the same, and the approval process is the same.
Sure. Well, it sounds like what you're saying is that there is more than adequate dollars available in the market to provide funding for these projects. It's a time-consuming process, a lot of studies, a lot of analysis, a lot of prep work to finally get to the point where approval is secured and they can start construction.
That's right. HUD recently introduced a notice that now allows us to do takeout financing for properties that are less than 3 years of age and have just recently stabilized. And that has been a real game changer in our industry.
Now, what do you mean a takeout?
We can do the permanent loan financing. So you
So
get a
converting
construction loan. So if we have a client who doesn't have the time to go through HUD, they can get a conventional loan that can be done much faster, and then come back, and we track the lease up. And when they get to not 3 months at 90% occupancy, we can start processing it for the takeout or permanent financing, which would be either through the agencies, Fannie Mae, Freddie Mac, or HUD.
Mm-hmm.
So.
Well, you mentioned agencies. So are you saying that the agencies are providing financing, or is there a lender, a bank somewhere that's providing the financing, and then these loans are sold in the secondary market?
These loans are on the HUD side. I can walk you through the process because that's what I'm most familiar with. But they're all some form of mortgage-backed security.
Okay.
And
so there's a primary lender involved, and then
that would be
sell
Berkadia
to the secondary market.
We're the lender. HUD issues a firm commitment to insure the mortgage, insure our loan. We take that mortgage-backed security, and then we go take another step, and we get Ginnie Mae to secure it and guarantee it, and they guarantee the full faith and credit of the government, along with timely payments to the investor if something were to go wrong with the
And then
loan.
are these loans either individually or perhaps in a pool?
They're pooled typically.
Okay, and then they're securitized. Tranches are then sold to the capital markets.
Right. We sell on the HUD side. We sell each loan individually. We go to market. We have a stable of 12 to a dozen to 15 different investors, institutional investors, and they'll buy the paper. There's a huge market for Ginnie Mae paper. So as soon as we get the commitment from HUD, we proceed to rate lock the loan. We go up to Wall Street, we sell the Ginnie Mae, and we close the loan with HUD, and then we deliver the Ginnie Mae within a couple of weeks of our loan closing.
So once the loan is approved, project is completed, funded, sold in the secondary market, then before it's securitized, is there some type of examination, due diligence, credit rating process that goes into that?
During the underwriting of the loan, prior to its issuance the commitment issuance from HUD, Berkadia does all the loan underwriting in-house.
Mm-hmm.
We submit the application process, and it includes a very, very detailed mortgage credit section. And so we will look at we're underwriting, let me make sure that I'm clear on this, we're underwriting based on the asset's performance.
Sure.
Absolutely. So that's what the loan constraints are based on. But we also look at the mortgage credit of the borrower, the sponsorship experience, and we want to make sure that the sponsor is one that's going to pay their bills, operate the property. We've got a good management company on board, somebody with experience, and
Mm-hmm.
we've got a good team. And we can help borrowers assemble their teams if they don't have all the pieces that they need. Yeah.
Laura, you mentioned the term non-recourse. Can you define that for us?
You take out a house loan, a home loan, and you're signing your name personally on the dotted line. And if you don't pay your bills, you lose your house and
Sure.
other things too, probably. Non-recourse means there's no personal liability associated with the loan. So these loans are underwritten based on the net operating income
Mm-hmm.
that they generate, and they are standalone, and so there is no personal recourse in the event of a default.
So the lender is looking only at the NOI, the net operating income capability of the asset itself.
Right. And then we're looking for the experience of the team as well,
Of course,
surrounding
sure.
it.
What's a typical down payment requirement?
It depends on the program, and nothing's typical. We do cash out loans on the
Mm-hmm.
HUD side at 80% of value.
Is that just kind of a rule of thumb? 80% is?
Yeah, 80% loan to value. If you go to a bank for a conventional construction loan, they're only going to give you 65, 70%
Mm-hmm.
of your.
What about 90? Can you get a 90%
if
LTV?
you're an affordable project?
Okay, what about a
designate.
95? Can you get a 95?
Not exactly. You're close, but we can finance up to 100%. If you're doing a refinance, we can finance up to 100% of your costs.
Now, why?
Not
Of the cost.
Of the cost, not to exceed. So that's your debt and any required repairs that you want to complete. So if you
Okay.
wanted to come in, say, do some upgrades, cosmetic upgrades, appliances, whatnot, to increase your rents, we could underwrite with the higher rents in place, assuming you're going to be completing
Sure.
the work in 12 months or less.
But we're still looking at that whatever the established LTV is.
Right.
Loan to value.
Right.
Can you give us an idea currently what are some of the interest rates, and are they fixed or variable?
They can be both, depending on what option you take. If you go to a bank or a conduit or Fannie and Freddie, the agencies can offer interest only for a certain period of time. So there's so many different options. On the HUD side, it's pretty simple.
Mm-hmm.
For refinances, they're fixed rate, 35 years, non-recourse, fully amortizing, and the rates today are in the 250s plus or minus.
Are they really? What
Yeah.
determines whether it's fixed or variable? What's
HUD
some
only
of the
does
criteria?
HUD only does fixed,
Okay.
and other lenders do. It depends on the program that's being
Sure.
offered, and there are lots of different programs.
That brings up another question. How can a lender commit 30, 35 years to a fixed interest rate? How is that possible? I mean, we're likely to go through 2 or possibly 3 business cycles during that 30 or 35-year term.
Well, the value of the asset is continuously appreciating.
Sure.
So the reality is the holding period, while we may place a 35-year loan or a 40-year loan for construction, the holding period is typically less than 10 years. So I've had borrowers, and I call them the deals that keep on giving. The borrowers, I've refinanced the same asset 3 and 4 times.
I see.
So
So in reality, they don't run the entire amortized term. So would that suggest that a maybe a 10-year treasury is used as kind of the index or one of the indexes?
Yes, for agency loans, that is correct. And for HUD and the Ginnie Mae rates, it's a little more complicated because they're not published and they're not tied directly with a spread onto the 10-year, which is in the 150s today, I believe. But with HUD, it really is based on what the investor's demand is, and then the prepayment penalty structure that's set up at closing. Typically, there's a 10-year lockout mechanism, a zero lockout, and a declining prepayment penalty.
A lockout meaning prepayment penalties?
A lockout for prepaying the loan. Typically, right now, it's the best execution or lowest rate is a 0-year lockout. So no lockout, and then a 10% declining prepayment penalty, 1% per year. So 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, open after year 10. It's a beautiful thing.
Well, on the non-recourse concept, which is really kind of fascinating, I've heard of the term bad boy carve-outs. Could you explain that for us?
Yes, that is used in all loans, and it is something that all borrowers understand pretty well. It's just for fraud, acts of fraud, criminal negligence, and so on. But that is the one liability you have to sign a carve out at closing on all these loans.
Well, it sounds like this market is massive in size and growing year to year. Is there an approximate number as to how many new building projects come online every year? Any statistics that are kept on that, other than just maybe dozens and dozens of them, I assume, to keep up with demand?
Every market, it's a great question, and every market has a different answer. And what I think is amazing about Berkadia is not only do we have a mortgage banking and investment sales and servicing division, we also have an IT department and technology that is just above the competition as far as researching, giving us data that into any market. And we can go so granular that we can get into a zip code, and I can tell you whether the site that you have is in an opportunity zone, what the crime rate is, what the average effective rents are, what operating expenses are in this market based on our portfolio of servicing, and I can go on and on. I can also give you a one-page diagram that shows every project under construction in that market and their delivery dates, what's been absorbed, so I can pinpoint and tell you everything about a market with just a glance at the computer capabilities, at the technology that we have.
It sounds like technology has really changed your business over the years. Is that a fair statement?
Absolutely, it is. It's a game changer, in my opinion, and the reason I joined Berkadia.
Has that given you the ability of doing more deals?
Absolutely.
Faster?
We have more knowledge.
18 months doesn't
I can
sound
make
like
a decision much faster, and I can have a client can walk in and I can do a demonstration on our computer, all of the technology that we can offer our clients at no cost to them. All they have to do is use Berkadia. We have a rent roll system called Red IQ that's fantastic. We can analyze and things so much faster, and we have a staff in Hyderabad of 750 people that work round the clock for us to size portfolios, and it just goes on and on. And they're wonderful.
How does a new investor get started in the multifamily market?
That's a great question, and I've worked with many of them over the years. I think really you pick up the phone and you kind of make the call to the local Berkadia rep, and depending on what you're trying to do, what market you're focused on, just explain what your goals are, and then we will work with you to help you form a team. We've put in
what's involved in a team. You've mentioned that a couple of times. What would be some of the skills that are needed to make up a good team?
If you're proposing a new construction project, we are going to propose we need an experienced general contractor. We need an experienced architect. We need a management company with experience, and we need a sponsorship that has experience. So the principals involved need to have experience in the same, building the same type and size of project that
So they need background and experience and training. What about their credit? If they've had credit issues in the past, does that automatically kind of put them out of the market, or
not automatically, but we'd have to look into that and kind of disclose that up front. And then what we can do is suggest a potential joint venture partnership with another developer
Sure.
with the experience and the financial wherewithal to get them going.
Are there certain types or size of multifamily projects that you would say are easier for a new investor to kind of cut their teeth on?
That's a interesting question. You know, we finance anything that's 5 units and up, but to be honest, economies of scale for an apartment property are in the 100 and up units.
Sure.
So something I would say 100 units and up, you know, that's more reasonable.
Sure. What are some of the commonly used credit review criteria when you're looking at a project and you're evaluating the investors, the owners? What are some of the credit criteria that you would look at?
We're going to look at their financial statements. We are going to do credit checks on them. We're also going to...
So you'll run credit reports,
of course,
FICOs, and
all of that good
all
stuff.
the normal credit underwriting standards.
I'm more interested in their resumes and what they've done in the past, and I want a list of similar type and size properties that they've done. And then, you know, we really want to look to their experience. And if there's a hole somewhere, we'll help them fill it.
Sure. We're just about out of time, Laura, but I have a couple more questions. Sort of look in your magic ball, and what is the future? And I think you've kind of alluded to this already, but what does the future of multifamily look like to you? If you look down the road, not just a year or two, but if you look down the road 5 or 10 years, what are your observations?
I think it's going to consistently, it's stable. It's going to consistently outperform other asset classes. It really always has. I'm very, very bullish, but I'm in the multifamily field, and but I can tell you, based on the number of loans that Berkadia 2 years ago versus 3 years ago, 2019 we closed 54 HUD loans, 1.1 billion. 2021 we've closed 154 loans to date, totaling over 2.6 billion.
That's incredible.
So we're going to beat our last year that was over 3 billion. So I'm really excited. I'm very bullish.
One final question. Would you care to give us your forecast on interest rates and inflation for the ensuing year?
You want me to pull out my magic 8 ball?
Yes.
I have one at home on my desk, actually. I did watch, I've been watching Janet Yellen. I've always been a fan of hers. And I guess everything's going to be hinging on where inflation goes toward the end of the year. And she's pegging it at 4%. So I'm thinking she's a lot smarter than I am. So I'm going to go with that.
You're going to go with that?
Yeah. And interest rates, interesting, on the agency and HUD side have not been as volatile as one would expect. They've been historically low, and to do a refinance for 2.5% or under 3%, and to do a new construction 40-year loan for, in the low 3s is phenomenal. And it's I don't see it. It may trend upward a bit, but I don't see anything given some catastrophic event occurring. I don't see anything terribly negative happening. So
well, that all sounds very exciting and positive about the about the ensuing future. Laura, thank you so much for joining us. We appreciate your insight. That concludes this episode of Stringham Real Estate Edge. Today's program was brought to you by Stringham Schools, educating real estate professionals since 1989. Visit stringhamschools.com to learn more. We want to thank today's guests, and don't forget to tell us what you think in the comments section below. I'm Gary Barnes, and I'll see you on the next episode of Stringham Real Estate